Everyone tells you to start investing early, but nobody explains what you should actually buy. Most people jump in with whatever seems popular, only to find out later that they built their portfolio on the wrong foundation. In this video, I'll break down 6 buy and hold forever index funds that solve that problem by doing the heavy lifting for you. I'll show you how each of these index funds grows, how each behaves during different market cycles, and what happens when you invest $10,000 into each one. I'll show you a fund that turns that $10,000 into a portfolio that pays over $20,000 in monthly dividend income by the time you retire. And in the end, I'll show you the fund that turns the same $10,000 investment into over $3.5 million. So let's start right at the foundation, the fund built on the backbone of America's biggest, most stable companies, and that is the Fidelity 500 Index Fund, better known as FXAIX. When people talk about building a hassle-free, steady foundation for long-term investing, they're usually talking about something that looks a lot like the Fidelity 500 Index Fund. And the reason is simple. This fund tracks the S&P 500, which is basically a snapshot of the 500 largest companies in the United States. Instead of trying to guess which single stock will win next year, FXAIX hands you a slice of every major player all at once. You're getting pieces of companies you recognize instantly: Apple, Microsoft, Amazon, Nvidia, Coca-Cola, alongside hundreds of others that support the economy behind the scenes. What makes FXAIX feel so reassuring is the way it blends stability with long-term growth. These are the companies that might fluctuate in the short term, but historically they've pushed forward over time, expanding, innovating, and adapting. And because this fund holds so many giants across different industries, it naturally balances itself out. One company can stumble without pulling your entire portfolio down with it. That's the beauty of indexing. Your success doesn't depend on perfectly predicting anything. It depends on staying invested and letting the biggest businesses in the country work for you. The way FXAIX compounds over long periods is where it truly shines. Even though the dividend yield isn't huge, the combination of dividends plus consistent price appreciation is what creates that snowball effect. When you zoom out over decades rather than months, the strength of owning the top 500 companies becomes incredibly obvious. Every year, they generate profits, reinvest in themselves, and push the overall market upward. You're simply riding along with them. And the cost? Well, that's one of the best parts. FXAIX is known for being extremely inexpensive, hovering around a 0.02% expense ratio, which means more of the growth stays in your pocket instead of being lost to fees. For beginners, this simplicity is a huge advantage. So let's break down the real-world numbers behind FXAIX so you can see what long-term compounding actually looks like. FXAIX has a current dividend yield of 1.11% and dividend growth of 3.32%. It delivers a healthy blend of income and stability, even though income isn't the main attraction here. What really drives returns is the fund's average share price appreciation of 12.79%. So if you invested $10,000, your balance is projected to grow to $11,390 after 1 year, $35,564 after 10 years, and $121,387 after 20 years. Stretch that to 30 years and the value reaches an impressive $408,056. Dividends are not the major driver here. Over 3 decades, your total value added comes out to $398,056, with $393,124 coming from pure capital appreciation and $4,932 from reinvested dividends. This index fund is the baseline for every investment portfolio out there. Now, if FXAIX is like owning the biggest, most established players in the country, then the Schwab Total Stock Market Index Fund, or SWTSX, is like opening the doors and letting the entire U.S. stock market walk into your portfolio. Instead of holding just the 500 giants, this fund spreads your money across thousands of companies from massive household names to small startups you've probably never heard of. And that mix is what gives SWTSX its own unique personality, broad, flexible, and surprisingly strong over long periods of time. The biggest difference you'll feel when comparing SWTSX to FXAIX is the exposure to smaller companies. Big companies like Apple and Microsoft grow steadily, but smaller companies often move faster because they're still expanding, still discovering their strengths, and still pushing into new markets. That extra boost of small and mid-cap growth is one of the reasons SWTSX has historically edged out the S&P 500 in long-term returns. You're not just buying the market leaders, you're buying the rising stars as well. But the beauty of SWTSX isn't just in performance, it's how naturally it balances itself. When big companies slow down, smaller companies tend to pick up the slack. When small caps struggle, large caps stabilize the portfolio. Everything works together like different gears in the same machine, each one turning at its own speed, but all of them moving the whole system forward. And because this fund is so broad, it feels incredibly forgiving. You don't need to know which company or which sector will do well next year. The entire US market is already included. Another thing people love about SWTSX is how intuitive it feels. If you've ever wondered what owning the market truly looks like, this is it. You're holding everything from technology and finance to healthcare, construction, retail, biotech, and energy. You're owning companies that build skyscrapers, companies that design apps you use every day, companies that ship your orders online, and companies that are quietly powering the grid beneath it all. It's the whole ecosystem, not just the top layer. This is the kind of fund you can set on autopilot knowing it'll capture whatever successes the market produces in the long run. Let's break down the long-term numbers so you can see how broad market compounding actually plays out. It has a current dividend yield of 1.06% and a strong dividend growth of 5.46%. Its average share price appreciation of 13.82% shows how powerful total market exposure can be. A $10,000 investment in this index fund is projected to grow to $11,488 after 1 year, $38,928 after 10 years, and $145,948 after 20 years. After 30 years, that same investment reaches $538,636. So over 3 decades, your total value added comes out to $528,636, with $521,860 in capital appreciation and $6,776 from dividend reinvestment. It's a simple, broad, and incredibly effective way to grow wealth over time. $500,000 is a great return for a $10,000 investment, but there are even better options coming. In a couple of minutes, I'll show you a fund that turns that $10,000 into a portfolio that pays over $20,000 in monthly dividend income by the time you retire. And in the end, I'll show you the fund that turns the same $10,000 investment into over $3.5 million. At number 4, I have the Fidelity US Sustainability Index Fund, or FITLX. Instead of trying to analyze which companies are good or bad, this fund uses a simple rule-based system to filter for U.S. companies that meet certain environmental, social, and governance standards. In everyday language, that just means it focuses on businesses that tend to treat people well, manage resources responsibly, and run their operations with long-term thinking in mind. But here's the part most people don't expect. FITLX isn't just about values. It has also delivered strong long-term growth. The companies that end up in this fund aren't random. Many of them are leaders in innovation, efficiency, and corporate responsibility, qualities that often support long-term performance. When businesses operate with fewer scandals, fewer fines, and fewer self-inflicted risks, they leave more room for growth. And that's one of the reasons FITLX has become a favorite among investors seeking solid returns without compromising their principles. You're not sacrificing performance to invest sustainably. Instead, you're investing in companies that know how to adapt, manage risk, and build trust with consumers over time. And because the fund still holds a wide range of industries, it doesn't feel narrow or restrictive. You're getting a healthy mix of tech, healthcare, consumer companies, industrials, and more, just filtered through a sustainability lens. Another reason why people like FITLX is because of how naturally it pairs with broader funds like FXAIX or SWTSX. If those two give you the entire market, FITLX gives you a more refined layer, something that feels intentional without being complicated. Together, they create a mix of broad exposure and meaningful principles, which is something many investors appreciate in today's market. As for the projections, it has a current dividend yield of 1.09% and an impressive dividend growth rate of 13.74%. Its average annual share price appreciation of 13.82% shows strong long-term momentum. A $10,000 investment would grow to $11,491 after 1 year, $40,122 after 10 years, and $160,861 after 20 years. After 30 years, that same investment reaches a remarkable $644,461. Dividends would total about $5,976 per year by year 30, or roughly $498 per month. Over 3 decades, your total value added comes out to $634,461, with $588,839 from capital appreciation and $45,621 from dividend reinvestment. At number 3, I have the Fidelity Nasdaq Composite Index Fund with the ticker symbol FNCMX. When people think of fast-moving, innovation-driven investing, they're usually thinking about something that looks a lot like this fund. This is the point in the list where the pace starts to pick up. FNCMX is built around companies that reinvent, push boundaries, and shape the direction of the entire economy. And unlike broader funds that mix in older, slower-moving industries, FNCMX leans heavily into tech, digital platforms, biotech, semiconductors, cloud computing, and the kind of companies that have been driving some of the strongest long-term performance in the market. The simplest way to understand FNCMX is this: it's the fast lane of the stock market. It carries more momentum, but it can also move a bit more unpredictably. That's because the companies inside it are often in rapid growth phases, constantly expanding, inventing new products, and fighting for market share. This means FNCMX has periods where it surges dramatically, and other times when it cools off for a while. But over long stretches of time, that blend of innovation and competition has historically created powerful returns. Where FNCMX really stands out is in the concentration of technology companies. You're getting exposure to giants like Apple, Microsoft, Amazon, Nvidia, and Meta, but also hundreds of smaller, fast-developing companies that don't always show up in traditional index funds, especially with a bigger portion size. The combination feels like owning both the leaders of the digital world and the next generation of potential breakouts. This mix is part of what makes FNCMX feel exciting, even for long-term investors who usually prefer stability. But even with all that growth potential, FNCMX still plays well with diversified portfolios. It's not designed to replace a broad fund like FXAIX or SWTSX. It's designed to enhance them. Think of it like adding a layer of acceleration. That's why so many investors pair it with broader index funds. It fills the role of a growth engine without requiring constant stock picking. What often surprises people is how much innovation compounds over decades. Technology doesn't grow in a straight line, it stacks on itself. New tools create new industries, which create new opportunities, which then feed back into even more growth. It has a current dividend yield of 0.5% and a dividend growth rate of negative 4.88%. FNCMX isn't a fund you buy for income. The real driver here is the average annual share price appreciation of 16.38%, a pace that compounds aggressively over time. A $10,000 investment in this fund is projected to grow to $11,688 after 1 year. $46,418 after 10 years, and $211,903 after 20 years. After 30 years, that same investment reaches an incredible $965,890. Dividends barely register, totaling just $4 per year by year 30, but the capital appreciation more than makes up for it. Over 3 decades, your total value added comes out to $955,890, with $955,328 from capital appreciation and $562 from dividend reinvestment. When you look at most beginner portfolios, there's usually one thing missing: real global diversification. That's where the Vanguard European Stock Index Fund, VEUSX, steps in. Instead of focusing solely on American companies, this fund spreads your money across developed European markets, giving you exposure to industries and economic strengths that the U.S. doesn't dominate. Think of VEUSX as a way of adding a new dimension to your portfolio that moves completely differently, reacts differently, and grows differently from U.S. stocks. The U.S. might lead in tech, digital platforms, and consumer brands, but Europe leads in luxury goods, industrial engineering, global banking, pharmaceuticals, renewable energy, and transportation. These companies might not trend on social media, but they are pillars of global commerce, producing steady revenue year after year, and owning them helps you build a portfolio that isn't tied to a single country's economy. What makes VEUSX especially interesting is the role it plays during different market cycles. U.S. stocks and European stocks rarely move in perfect sync. When one region slows, the other can hold steady or even accelerate. That natural zigzag balance is a powerful way to smooth volatility over long periods of time. And since VEUSX focuses on developed, stable economies, countries like Germany, France, Switzerland, the Netherlands, and the UK, it feels more secure than investing in fast-changing emerging markets. But here's the part many investors overlook. Europe's companies often return a larger portion of their profits to shareholders. That's why dividend yields tend to be higher compared to the US. VEUSX captures this by holding established companies with long histories of paying and growing dividends. Even though European markets haven't matched U.S. tech-driven growth in recent decades, their combination of income and stability creates a different but very valuable kind of compounding, especially when you reinvest those dividends back. And the fund itself is incredibly simple to own. Vanguard keeps costs low at about 0.08%. The holdings are transparent, and the index approach means there's no guessing or forecasting. It has a strong current dividend yield of 2.83% and dividend growth of 13.73%. VEUSX delivers meaningful income. Its average annual share price appreciation of 5.08% reflects Europe's steady but slower-paced growth. Having lower appreciation but higher dividends means this fund accelerates later in the compounding cycle, usually the last decade. So, a $10,000 investment in this fund is projected to grow to $10,791 after 1 year, $24,337 after 10 years, and $96,348 after 20 years. After 30 years, that investment reaches a stunning $1,068,843, thanks largely to the reinvestment of those strong dividends. Dividends alone would total about $245,945 per year by year 30, or over $20,000 a month. Over 3 decades, the total value added is $1,058,843, with $191,387 from capital appreciation and a massive $867,456 from dividend reinvestment. And finally, taking the number one spot in today's list is a technology index fund. Technology moves the world forward, and if there's any fund on this list that captures that energy directly and unapologetically, it's the Vanguard Information Technology Index Fund, VITAX. This is the fund that doesn't just touch innovation, it lives in it. Every company inside VITAX is tied to building the digital infrastructure, software, hardware, and systems that the modern world runs on. If FNCMX is the fast current in the middle of the river, VITAX is the rapid acceleration right beside it, carrying some of the most transformative companies in existence. The simplest way to understand VITAX is that it's a pure-play technology fund. Instead of mixing tech with other industries, VITAX focuses entirely on companies that make the digital world possible. You're getting exposure to giants like Apple, Microsoft, Nvidia, Broadcom, and Adobe, businesses that have spent decades dominating their fields by relentlessly innovating. These companies shape how we communicate, build, create, analyze data, and solve complex problems. And that focus is what makes the long-term growth potential of VITAX so powerful. What sets VITAX apart is its intensity. This is not a balanced fund. This is not meant to be the entire portfolio. VITAX is a high-octane engine designed to amplify growth when paired with broader, more stable funds like FXAIX or SWTSX. When the tech sector rises, VITAX takes the biggest advantage, which you can see from its historical performance. And the reason is simple. Innovation compounds in ways most people underestimate. New technologies don't grow in isolation. They stack, interconnect, and unlock entirely new markets. Cloud computing leads to AI. AI leads to automation. Automation leads to new industries. And each layer adds more fuel to long-term compounding. But with that upside comes the reality of volatility. Tech doesn't move slowly. Prices can swing. Entire sectors can rotate, and headlines can push the market up or down in a single day. But what long-term investors understand is that innovation rarely reverses. The world becomes more digital, not less. Companies rely more on software, data, automation, and AI, not the other way around. And because VITAX owns the leaders building that future, the long-term trend still points upwards even if the path is bumpy at times. VITAX also benefits from something most people forget. Dominant tech companies often operate with extremely high profit margins. They scale faster, they pivot quicker, they adapt better during economic shifts. And because technology spreads across every industry, VITAX catches the upside of countless innovations happening far beyond Silicon Valley. So let's break down the long-term math behind VITAX, because the compounding story here is nothing short of dramatic. With a current dividend yield of 0.4% and a dividend growth rate of negative 3.75%, income, again, is not the selling point here. The real star is the average annual share price appreciation of 21.82%, one of the strongest growth rates among major index funds. A $10,000 investment in this fund is projected to grow to $12,222 after 1 year, $72,842 after 10 years, and $524,509 after 20 years. After 30 years, that investment reaches a staggering $3,774,554. Dividends barely contribute, totaling just $2 per year by year 30, but capital appreciation takes over completely. Over 3 decades, the total value added reaches $3,764,554, with a massive $3,764,144 from capital appreciation and only $410 from dividend reinvestment. Index funds are great if you want to grow your money, but they're not the go-to option when it comes to dividends. Click the video on the screen to find out how to turn a $10 daily investment into a portfolio that pays over $5,000 in monthly dividend income.